Welcome to our session on depreciation. While standard recurring expenses are deductible immediately under Section 8(1), capital assets that provide long-term benefits, like motor vehicles or computers, must be depreciated over time under the Uniform Capital Allowance System, or UCA. A depreciating asset is simply one with a limited effective life that loses value as it is used. To calculate this claim, we must know the asset's effective life, which is the total time it can reasonably be used to produce income. While clients can self-assess this life based on industry standards and expected wear and tear, it is generally much safer and more common to adopt the Commissioner's published effective life determinations, specifically TR 2022/1 for our current tax years. Before calculating the actual decline in value, we need two fundamental figures: the cost and the start time. Under the UCA, an asset's cost has two elements. The first element is the purchase price plus any delivery or installation fees. The second element captures capital improvements made after you hold the asset, such as adding an expensive alarm system to a vehicle. Note that standard maintenance, like replacing worn tires, is a repair and deducted separately, not added to the cost base. The start time is incredibly important. It is the date the asset is first used or installed ready for use, even if that initial use is purely private. You only start depreciating from this exact date. We use two primary methods to calculate depreciation: prime cost and diminishing value. Prime cost assumes the asset's value drops evenly every year. The rate is simply 100% divided by the effective life. Alternatively, the diminishing value method assumes the asset loses more value in its earlier years. This rate is 200% divided by the effective life, and it is applied to the adjustable value, the remaining balance, each year, rather than the original cost. Because diminishing value gives higher deductions up front, it is the most popular choice. However, if a client expects to be in a higher tax bracket in the future, prime cost might be strategically better. Remember, once you choose a method for a specific asset, it is locked in forever. To help visualize how these two methods compare based on different asset parameters, here is an interactive depreciation calculator. It is rare that a client buys an asset exactly on July 1st and uses it 100% for work. When an asset is bought mid-year, we must prorate the claim based on the exact number of days it was held. Furthermore, if the asset is used for both work and private purposes, we must strictly apportion the claim by the taxable use percentage. This brings us to two vital tracking metrics. The adjustable value is the original cost minus the total physical decline in value of the asset, regardless of whether it was used privately or for work. This is the number we use to calculate the next year's diminishing value claim. The written down value is the original cost minus only the tax-deductible amount you successfully claimed. We need the written down value later when we dispose of the asset. Several external factors alter an asset's cost base. If your client is a standard employee not registered for GST, the cost base includes the GST paid. If they run a GST-registered business, exclude the GST, as they will claim an input tax credit. For luxury passenger vehicles, the ATO sets a strict car limit. For 2025 and 2026, you cannot depreciate a car beyond $69,674, even if it cost $100,000. You must also separate repairs from improvements. If a worn-out engine is replaced with an identical one, that's a repair and is fully deductible. If it's upgraded to a superior diesel engine, that's an improvement and must be capitalized. Lastly, under TR 2024/1, evaluate composite assets carefully. A packaged desktop computer is one asset. A portable GPS that can be moved between cars is a separate asset. Who actually claims depreciation? The legal owner usually does, but tax law looks at the economic holder. In a standard operating lease, the lessor holds the asset. But in a hire purchase or finance lease, the user bears the economic risk, so they are the holder and claim the depreciation and interest. A massive concession for non-business taxpayers is the immediate $300 deduction. If an asset costs $300 or less, and is used more than 50% for work, the entire taxable portion is claimed up front. However, be wary of the set and multiples rules. You cannot buy 10 identical $80 fire extinguishers and claim them all immediately because the multiple total exceeds $300. Similarly, a set of encyclopedias costing $65 each but forming a set over $300 must be depreciated over time. When a client sells, scraps, or destroys an asset, we trigger a balancing adjustment. This ensures the taxpayer claims exactly the true cost of the asset over its life, no more and no less. We compare the termination value, usually the sale price or insurance payout, against the current adjustable value. If the client sells it for more than the adjustable value, they overclaim depreciation, and that profit is added to their assessable income. If they sell it for less, they underclaimed, and they receive an additional tax deduction. Crucially, if the asset had private use, the balancing profit or loss is reduced by the historical non-taxable percentage. Also, if the asset was a luxury car subject to the car limit, you must artificially reduce the termination value by the same ratio that the original cost was restricted. To reduce compliance burdens, clients can utilize a low-value pool, or LVP. Two types of assets can enter this pool: low-cost assets, purchased for under $1,000, and existing, low-value assets, that have depreciated using the diminishing value method to an adjustable value below $1,000. The massive benefit of the LVP is simplicity. You do not prorate by days held. Any new asset entering the pool gets an automatic 18.75% deduction in its first year. In all following years, the entire pool balance depreciates at 37.5%. A vital warning: placing low-cost assets into an LVP is a once-and-for-all choice. Once a client opens a pool and adds a low-cost asset, every single low-cost asset they buy in the future must be added to that pool. Finally, let's look at software and record keeping. Computer software is a unique asset. If it costs over $300, it must be depreciated using the prime cost method over an effective life of 5 years. You cannot use diminishing value for software. However, if it costs under $1,000, it is fully eligible to bypass this rule and be dumped straight into the low-value pool. Record keeping is the backbone of depreciation. Because assets carry over multiple tax years, you must retain all records, including purchase dates, initial costs, effective life decisions, and balancing adjustment calculations. For a minimum of 5 years from the end of the income year, the asset is fully depreciated, pooled, or sold. This concludes our guide into depreciation.